Welcome to the Deep Dive. Today we're digging into Fed Chair Jerome Powell's big speech from Jackson Hole. That keynote on August 22nd really got the markets moving, didn't it?
Oh, absolutely. Markets jumped and traders started pricing in a rate cut much more aggressively.
Right. So our mission today is to unpack that. Was it a real pivot or, just some careful Fed speak?
Well, that's the fascinating part. He talked about this curious balance. He definitely opened the door, maybe hinted at September for a cut, but crucially with some pretty strong caveats.
Okay.
So we'll look at what he actually said, how markets reacted almost instantly, and what analysts are now pointing to as the good and maybe the bad implications for you.
All right, let's start there. This curious balance. What were the sort of high-level takeaways from this speech itself?
So Powell specifically flagged that phrase curious balance regarding the labor market. He noted there are downside risks to jobs, which, could make the case for easing policy if the data starts to look weaker.
If. That's the key word.
Exactly. Because on the other hand, he was very clear that inflation risks haven't gone away. He mentioned tariffs, for instance, as a potential upward pressure. So his message was, any easing, it's going to be cautious and conditional. It really depends on the numbers coming in, not a promise.
Okay, so he dangled the possibility, but kept his options wide open, which makes the market reaction even more interesting, right? Treasury yields fell, stocks jumped.
Instantly. Yeah, yields dropped, equities rallied pretty hard, and you saw traders immediately recalculate the odds. That probability of a September cut, just a standard 25 basis point one, shot way up.
And commentators called it a dovish tilt.
Yeah, that was the term bouncing around. A dovish tilt that, fired up the markets, but still had that cautionary footnote attached. He didn't go all in.
Makes sense.
Yeah.
So thinking about the potential upside for people listening, the good side, if the Fed does cut in September, what does that mean in practical terms?
Well, connecting it to the bigger picture, a cut could really help. For you, it potentially means cheaper borrowing. Think lower mortgage rates eventually, maybe more affordable car loans, easier credit for businesses looking to expand.
Okay, so reduced debt costs.
Right. Which could free up money, maybe boost spending or investment in housing, that kind of thing. Plus, it provides some relief for the markets themselves, potentially supporting asset prices, and, crucially, it could help cushion a slowing job market, protecting jobs, easing the strain if credit's been tight for families or small businesses.
That all sounds pretty positive. But there's always a flip side, isn't there? What are the risks here? The bad outcomes if they cut too soon?
That's the big worry. What if inflation picks back up? Powell himself warned about tariffs pushing prices higher. If they ease too early while demand is still okay, they risk letting inflation get sticky again.
And then they'd have to reverse course, maybe hike rates again later.
Exactly. Which brings in credibility costs. The Fed doesn't want to look like it's flip-flopping or getting caught behind the curve. That damages trust in their guidance. Right. And, there's the asset price issue. Super low rates can sometimes inflate bubbles, housing, stocks, if the underlying economy isn't really strong enough to justify those high prices.
And you mentioned mixed signals from Fed officials.
Yeah, not everyone on the committee sounds quite as ready to cut. Some still seem more worried about inflation, more hawkish. That just adds another layer of uncertainty about what they'll actually do.
Okay, so putting it all together.
Yeah.
What's the consensus now among analysts and strategists? What should we be bracing for?
Well, the majority view among market economists seems to be, yes, expect at least one 25 basis point cut, probably September, if the next jobs and inflation reports show some softening.
Conditionality again.
Always. But you do have others, some Fed officials maybe, certainly some econometricians with the folks building the complex models who are more cautious. They want to see really clear proof inflation is cooling off sustainably.
And the investment strategists.
They're largely adjusting their forecasts for easier policy, but there's definitely a minority voice warning that maybe the market's gotten ahead of itself, priced in too many cuts, and could be set up for disappointment if the data doesn't play ball.
So it really feels like everything hinges on the next report and the one after that. Powell's data-dependent phrase seems more relevant than ever.
Absolutely. That's the key takeaway now. Data dependency is paramount, which means for you, expect markets to be volatile. Each big data release, jobs reports, CPI inflation, the Fed's preferred PCE measure could cause significant swings as everyone tries to guess the Fed's next move.
So wrapping this up, what's the single biggest thing that stands out to you from all this? It feels like a door cracked open, but the path forward is pretty foggy.
Yeah, foggy is a good word. The door's open, but there are clear risks on both sides. My final thought for you is this. We know the Fed is watching every single data point like a hawk now. So how might you start looking at those upcoming reports? Knowing what drives their thinking, that balance between jobs and inflation, which numbers will you focus on to maybe anticipate what the market might do next and how it could affect your own finances? Something to think about.